This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Investment is a journey, and the strategies that you use when you start out will be very different to the ones you use after many years of investing. So in this video, we look at 4 proven strategies that will see you through that investment career. And if you do want to learn about investing, what better way could there be than to join our online community by supporting us on Patreon? You get access to the chat application where you can talk to me and other members of the community and ask any question you like. And you also get access to a growing library of members-only exclusive content. And you can join us for just $10 a month, which is a great bargain, by looking at the description below or clicking on the link above. So now let's look at that investment journey and the strategies you can use in a bit more detail. Cast your mind back to the time you learnt how to drive. Did you do that in a supercar? Or how about pilots? Do you think they learnt how to fly at the controls of a commercial airliner from day one? No, of course not. The way we learn is to start off simple and then build up complexity as we go along. It's just a more natural way to learn. And that's why I find it very surprising when I see videos that say you should do single stock investing from day one. That's very risky, and it's very likely to underperform just buying a global market index. Remember that professional investors fail to beat the market about 80% of the time, and they've got huge resources behind them. Research departments, a Bloomberg terminal, and they can almost spend 24 hours a day looking at investments because that's their job. Trying to choose single stocks which outperform when you're just starting to invest is kind of like watching a few YouTube videos and hoping you could become a neurosurgeon. So if you are getting started, there's a really simple way to do that, and that's by buying just one fund. What's good about that is that it limits the biggest risk to your investments, which is your own personal behavior. If you only have one fund, then you only have 2 choices. You can either buy more of that fund or you can sell some of the fund that you already own. And for long-term investing success, all you have to do is not sell until you need the money, preferably after decades of investment. So when you buy a fund, intend to hold it for a very long period of time and let markets work their magic. The kind of fund you'll need to do that is a multi-asset fund, which contains both bonds and equity. Now, one example of that is life strategy funds produced by Vanguard. But what's really important to understand is the level of risk, which is determined by how much of your portfolio is made up by shares. Notice how these are risk graded. These are the US versions of life strategy, and the lowest risk one is called the income fund. You can see that its risk level is low to moderate, and also that its investment horizon only needs to be between 3 to 5 years, because a fund that doesn't crash a lot is less likely to lose money just before you need it. But if you invest for more than 5 years, then you can afford to dial up the risk to a higher level, and that's by having more stocks in your portfolio. So it goes to 40%, 60%, 80%, and if you want a 100% equity fund, you can just buy a global equity tracker. The UK versions of Life Strategy I think are better labelled because they tell you precisely how much equity is in the portfolio. So you've got Life Strategy 20%, 40, 60, 80 and also 100%. And again they're showing this risk-reward trade-off, with 20% equity having lower risk but also lower reward over the long term. And also this is suitable for shorter term investments. And as you dial up the risk, then a longer investment horizon would be more appropriate. But the compensation for that higher risk is a potentially higher reward, which you're more likely to get if you invest for 10 years or more. But we're now kind of spoilt for choice. It's not just Life Strategy which are good, cheap multi-asset funds, but there are several competitors which are also fairly low in fees. So in the US, you can literally go to this slider and select a fund which is suitable to your risk appetite and your investment horizon. Here is that website, and you can change the level of risk from conservative through moderate all the way up to aggressive. Yahoo Finance in the US has this great mutual fund screener where you can say what expense ratio you want, and ideally you'd have something below 0.4% per year. Competition from Vanguard has ensured that those prices have come down for multi-asset funds, and you can also choose the level of equity in the portfolio. And with those settings, I found 13 funds which have an expense ratio of 0.4% or less, and which have that level of equity. So there are many cheap choices out there to allow you to have a single fund and to invest as simply as possible when you're starting out. The next level of complexity is to have two funds. Now, if you're a UK investor and you want to look at the potential funds that you can use for that, there's a whole video about it, and you can click through to that video using the link provided. But using the website ETFDB, I've listed 10 funds here which give you global equity exposure, and they do that for a very low expense. Even the most expensive of these funds only charges you 0.2% every year. And for the bond component, again, you can see that these are very cheap funds. Now, if you do want to see the alternatives for UK investors, you can always refer back to that two-fund portfolio video. Now, in the graphs that follow, for the global stock part of the portfolio, I've used the Vanguard Fund VT, which tracks both foreign and US stocks, and includes both developed and emerging markets. And for the global bond fund, I've used AG, which is provided by iShares. Now, strictly speaking, that's not a global fund, but it did have a lot of history, so I could look at what happened to prices through the global financial crisis. So what I've done here is to construct 6 portfolios. Just like with Life Strategy, I've dialed up the amount of equity from 0% all the way up to 100% for the riskiest portfolio. Now, for the lowest risk portfolio, you can see that the price doesn't fluctuate much. It's a fairly steady line. But what you can also see is that over a long period of time, it's the one that performs the worst. Whereas the 100% equity portfolio fluctuates wildly, and it loses a huge amount of money during the global financial crisis, about half of its value in fact, but then it recovers very quickly and goes on to outperform all of the other portfolios. Now, during this period of time, you probably would have had to rebalance your portfolio. So say you started out with 60% equity and 40% bonds. After a steep fall in the equity market, the actual proportion of your portfolio, which is in equity, would have fallen. So you'd have sold a bit of your bond fund and bought more of your equity at the lower price. And that's why a two-fund portfolio takes more maintenance than a single multi-asset portfolio, because you have to do the rebalancing yourself. If we look at a risk-return plot, with high risk here on the right, and low risk here on the left, and low returns at the bottom, and high returns at the top, as you increase the risk of the portfolio, and as we move from left to right, you can see that the return also increases. And over this 15-year period, you'd have made about 4% with a 100% equity portfolio every year. Whereas with a 100% bond portfolio, you'd have only made about 1.5% per year, but the risk would have been much lower. Now, your choice of risk really depends on your risk appetite and your investment horizon, but also your risk capacity, which is how much of a loss you can afford to make without affecting your quality of life. But what I like about this graph is that it shows the risk-reward trade-off very clearly. If you are willing to take more risk by having more equity in your portfolio, you have a much higher probability of getting a better return. Once you've been investing for a while, you may decide to switch to something which is called core satellite investing. Now, the idea here is that this is the core. This is the really safe, globally diversified, asset class diversified core of your investments. And the core is usually low fee and consists of passive funds. Now, the drawback with that is that it's boring. You may want to do stuff which is a bit more exciting and which you think is going to give you better returns. Whether you're right about that is another matter, but hey, investment should be a little bit of fun, right? So alongside your diversified, cheap, core portfolio, you have something a little bit more exciting, maybe something riskier, And that could be a small proportion of your portfolio, so that if things do go wrong, it's not going to be a disaster. But it does add a little bit of spice and a bit of engagement to exciting aspects of investing for your portfolio. Now, what could that satellite investment be? Well, it could be some kind of thematic investment. There could be a narrative that robots are cheaper as a workforce and they're also more productive than humans. So you could choose companies which produce those robots. And that way you could make money from that long-term trend in the workplace. Now, the drawback with thematic investing is that it can be more expensive in terms of expense ratios. So if you look at these robotics funds, which I've got from ETFDB, which has a whole section on thematic investing, you can see that they're all above the expense ratio that we saw for those global bond and equity funds. In fact, the cheapest of them is 0.2%. Another popular theme is marijuana stocks, as marijuana becomes legalized in more countries and in more US states as time goes on. And big respect to the asset managers who've come up with some of these amusing tickers, such as Toke and YOLO. But again, look at these expense ratios. Even the cheapest of them is 0.5%. So yes, this is great fun and you can engage with a particular theme with which you feel a connection. But just bear in mind this shouldn't be too much of a large proportion of your portfolio, because these narratives often turn around quickly and start to underperform. But you can rely on the core of your portfolio to drag your returns up over the long term. The most complicated strategy which we'll consider is constructing a portfolio which uses detailed asset allocation. And you can see this is much more complicated. It's kind of like the inside of a watch. There are lots of moving parts and it's very difficult to make sense of it. And that's because now you could have dozens of funds. So just in the equity part, you can have many different components. There could be the US, Japan, emerging markets, and all of these would have a separate fund which tracks that region. And then for government bonds, you'd also have regional allocations according to where you think yield curves are going to be, but also which regions are going to give you the best returns. And you'd also want to consider things like central bank policy, because that affects bond returns. Or maybe you want to diversify by having different asset types, maybe real estate investment trusts below me here. And again, there you can have regional real estate investment trusts. Or you could break it down by sectors. There are different sectors for real estate, just as there are for equity. Or perhaps you want commodities. Gold is a very popular one, but you may consider others, such as oil or even agricultural products, because these could diversify your portfolio. But all of them are driven by different factors. So that makes it very difficult to keep on top of all of the different changes over time. If you do want to learn about asset allocation at that kind of level of complexity, I've created a course, and it's probably the most complicated one we offer. So to find this, just go to that learning menu on our website and you'll find the courses we offer. Now, this probably isn't appropriate if you're just starting out in investing, but if you've been investing for a while and you want to get broader knowledge and you want to extend your knowledge of how macroeconomics affects investment, then this could be appropriate. And even some people who work in investment banking have done this course because, hey, everyone doesn't know everything, right? So it's probably best to start simple and then maybe make your investments more complicated as time goes on. But even I just use 3 funds in my portfolio because I know it's important to keep things as simple as possible. And having more complexity doesn't necessarily improve your long-term returns. Now, one of our services that we offer at no cost is our weekly roundup. And this is an email which talks about the relationship between macroeconomics and the impact that it has on your investments. And it's another great way to learn about markets, but also what drives them. And to get access to that, there's a link which you can see beside me here, and there'll also be a link in the description of the video below. So if you do want to join us on Patreon, then again, there's a link on the far side of this page, which you can click on in order to join us. It's just $10 a month. And as always, thank you for listening.